MEM Investment Research, and today we will be covering sector rotation and what that means for you and how you can capitalize on the rotation that does indeed take place in the market. Certainly we're seeing a lot of it over the last couple of days, of course, and I'm glad you joined me. I look forward to sharing my many years of experience in the markets with you and reviewing some of the finer points as it relates to knowing your sectors and how you can spot rotation in and out of each of them. So let's go ahead and get started. I'll provide you with a brief background. Again, McGonagle, and I'm currently the founder of MEM Investment Research. And our team puts out a weekly newsletter that provides an oversight into the broader markets as well as individual stock ideas, and we also, as part of that, have a mid-week report that touches on anything unusual that's going on or any of the stocks that look even more compelling than they may have over the weekend. I also have a sector strategy monthly report as well. So I have been in the industry, some of you may know, for over 25 years. Started out my career, I'd moved to New York right out of college, and very luckily befriended someone who was able to secure a job interview for me with Goldman Sachs, and that worked out. I was able to work on their fixed income trading floor, and this was the early 80s. It was super exciting. I knew I had found my home, if you will, and so I stayed there for a bit, and then from there I moved on to what's called the buy side. And I was with a very large New York institutional insurance firm and started out, again, low man on the totem pole. And then from there I was able to work my way up. I started out as an assistant portfolio manager and then eventually went on to become a portfolio manager of over $2 billion in assets. And again, this was fixed income. And it was during this period, because the company I was with was quite large and I was at that time running quite a bit in the way of assets, I came to see and understand how important information flow is as far as making decisions. And of course, during the 80s, the playing field was not level. As an institutional investor, we would get phone calls alerting us to certain potential activities, none of it illegal, it was just the way the street worked. And then of course, thankfully the SEC stepped in after the '99 bubble and put in legislation that mandated that information be distributed to everyone, meaning self-directed investors at the same time as these big portfolio managers, and all of that is really, I think, exciting. As an individual investor, you are going to have access to that same information in a very timely manner, and there's a lot more in the way of tools that are available as well. So all of that, I think, bodes well for the individual investor, and as you continue to educate yourself, I think you're going to have an advantage over some of these bigger mutual fund firms that have legal teams watching their every move. They are running large amounts of money, so they don't have the flexibility that you might have. So again, it's a great, exciting time to be putting your own money to work and growing it. So for whatever purpose, whether increasing your retirement funds and so forth. So currently, with that, I did, after being in New York in the fixed income side, I moved with my then new husband to Los Angeles, and I had the great opportunity to work at William O'Neill and Company. I was there for 15 years in what was called their institutional marketing. So now I moved to the equity side. I was working with top portfolio managers and analysts throughout the world. And part of my role was to teach them the O'Neill methodology and then also advise them on the markets and on stocks that they may have had on their watch list. If the stock looked poised to out or underperform, I would alert them. And currently, in my new role with MEM Investment Research, I do still work with institutional advisors, but I am, over the past year, have broadened out to share my knowledge with self-directed investors. And again, it's really, for me, something exciting. It's adding a new dimension, if you will, to my work. So let's go ahead. This first item is a disclaimer, and again, there is no need to read the entire thing. I did want to point out that today's presentation is for educational purposes only. There is no recommendation to buy or sell any type of security. So I did want to get that out of the way, if you will. So here is what we will be covering today. And the primary goal for me is to help teach you, educate you on how you can spot sector rotation. And studies have been done regarding the impact that utilizing a sector rotation strategy can have on your performance. And in particular, Fidelity Investments has done, among others, very extensive studies, and they have found over the last 20 years, if you were to use a sector rotation strategy as opposed to a market type, by that I mean small cap, mid cap, large cap, there is certainly that way of investing, but they were focused more on being able to identify when sectors were coming into or out of favor. And if you did use that strategy, on average, you did outperform the broad markets by 20%. So, and hopefully by the examples that we will be reviewing, you will be able to get a sense of really how important this sector rotation can be to your strategy. And so we will go ahead. I will explain each of the various sectors and what their weight is in the markets and what their role is, so to speak. The second item is what are exchange traded funds, and ETFs are the best way that you can spot sector rotation. Again, we will go ahead and get into that specifically as far as which ticker symbol each sector has, so that you can stay on top of that. I mentioned what is the importance of spotting the rotation, and most importantly, you want to be able to spot when the rotation that has been coming into a given sector, when that is over. You do not want to overstay your welcome in a given sector. So let's go ahead and start by giving an overview of precisely the purpose of sectors and why this market of 7,000 plus stocks in the U.S. market alone, why has it been broken down into sectors? And really, quite simply, the reason is that given that many stocks, it's really a way to create to get rid of the chaos, for lack of a better word, and to create a systematic way that investors can really identify flows in and out of a group. So what you'll find is each sector that we are going to be reviewing has its own attributes as far as the subsectors within it, what types of stocks are in that sector, and subsequently various sectors perform in a certain manner depending on where we are in the not only economic cycle, but also what phase we are in the markets. Currently, we're well into the 7th year of a bull market. It's a later phase, so you'll want to know what sectors tend to do well at that point. So, so let's go ahead and dig in. This first, what we're looking at here in this listing is I did forget to mention to you that depending on what trading platform you use or what research services you use, there are anywhere from 9 to 11 sectors that various research firms put the markets into. And for our purposes today, I tend to focus on the S&P sectors, and that has 9 sectors, and they are each listed here. So what you're looking at is this list is in order of weighting. So quite simply and very quickly, you can see technology has the highest. It's the sector with the largest percent of stocks within that, and that's followed by healthcare and then financials and so on. And there are a couple of reasons that you need to know this. First, I did want to point out, for instance, financials are now listed as the third, 12.8% in weighting. But I will tell you, prior to the 08-09 banking collapse, financials were a much larger, well into the 20s%. They were in fact the largest percent of the S&P. And of course, that banking collapse did result in a number of bankruptcies, and the market caps have come down quite a bit since their peaks back then. So now it is only 12.8%. And you'll see the shifts periodically as companies morph into different focuses, and what it's based on is the primary source of the company's revenue is how they go ahead and put it into a particular sector. Now, of course, more recently with all of the incredible innovations that we've seen in technology, and then of course when you look at the broader markets, there are heavyweights, Google, Apple, Facebook, they are actually Amazon, I may or may not, depending on, again, what service you're using is where they would subcategorize that. But technology, in addition to having many, many innovative new companies being IPO'd, it also has a lot of the heavyweight companies, so that's hence why they are that top weighting. And then, of course, we go drill down. Energy is another sector that used to be quite a bit larger, but given the collapse in the energy space, it's now 7.2% of the broader markets. So when we, or I, for instance, I have a sector strategy monthly report, and one of the very first things that I do, and you'll see this with other services, they'll advise you whether you should overweight or underweight a given sector. And basically what that is telling you is that given your basket of stocks and your portfolio, if there is a suggestion that you overweight, doesn't mean that you have to follow it to the T, but you certainly, it is suggesting that you can have more than 21% of your stocks in technology, and you could very easily outperform. Oftentimes market weight is another, so it's either over, under, or market weight. And again, if you can get this sector, not only classification, but weighting down as part of your investment philosophy and the way that you invest, it really is going to benefit you. And I think you'll see as we drill down, you'll get to see the real importance that being able to view and get on top of these sector moves, how that really can help your performance in a number of ways. So let's go ahead, and what we're starting with here, and I'm going to go ahead and review these sectors by their weightings. And so the first one, of course, is going to be technology. And what I wanted to point out, what we are looking at here, again, I mentioned to you that we are using the S&P, their ETFs. So the technology sector is XLK. That is the ticker symbol for you to go ahead and utilize and view so you can stay on top of this sector. We're looking at a weekly chart. So each bar here represents 1 week of trading activity. I've kept these quite simple using only key moving averages. In this case, it's the 10-week or 50-day, or the 40-week or 200-day. So what we're looking at here is mid-2015 until I believe yesterday or today. And so what I did want to point out to you with technology sector, and of course this is all hindsight, but this is our work was able to pick up on this as it was unfolding. So we had, of course, the huge downdraft in the beginning of 2016. You will see this in a lot of the sector charts, of course. But technology, as the markets turned in February, there were a number of leadership stocks at that point that showed their hand. NVIDIA, of course, comes to mind. NetEase is another. These are stocks that were on our list, and then if they broke down, we took them off. But we were starting to see a pickup in technology as well as other sectors in this beginning period. But lo and behold, as these companies started to report their quarterly first Q1 2016 earnings, there was a stumbling. So they're from again our work, and hopefully you can see this as well, there was a falling out of favor of a number of technology stocks. And as we go through some of these other sectors, you'll be able to see the difference in other sectors that indeed during this period did come into favor. So what I pointed out here is this is mid-July, and this is again a weekly bar. And during this particular week, we saw what's called a reversal week. And by that I mean the overall pricing of this ETF, this technology ETF XLK, it undercut the prior week's low in price. It also undercut that 200-day moving average. You can see that the price did get quite low. It was a bit unnerving, but indeed it went on to close the week not only above the 200-day, above the 50, but also above the prior week's close in price, and most importantly, it did so on volume. So this is what we recognized by reviewing and staying on top of these sectors, was that indeed the technology sector had reversed. And it's one thing to see that, and that could be interesting, but really from here what you will want to do is then drill down, because each one of these broad-based sectors has many subsectors and subgroupings beneath them. And again, depending on what your trading platform is, that will indeed be what you would use for the various subsectors. Now with technology, I will tell you that the heaviest weightings in technology are software, semiconductors, hardware, and then storage stocks. And of course there are many other subgroups that can be equally compelling, such as telecommunications and so forth, but those are your heavier weightings. So when you see this type of reversal, you'll want to go in and look at those subgroups. Most trading platforms do have your bigger sector information and then your subgroupings, and ideally you can then drill down and see. Stock.com is very, very useful with that. They do it intraday, weekly, monthly, and so on. So you can really stay on top of, again, those subgroups, because what that is going to do is provide you with the confidence that that reversal is potentially real if you're seeing a broad-based participation of the subgroups within that. So let's go ahead and take a look. I mentioned to you that semiconductors is one of the heavier weightings within technology. So I'm taking you back to this mid-July reversal, and from viewing that reversal and then drilling down, we were indeed able to see that semiconductor stocks were really coming into their own. And again, you'll see this as compared to other subgroups and how they performed during this July period. But anytime you see these type of gaps up, again, this is a weekly, it's telling you that there are buyers in here. So at that time, we did put a number of semiconductors on. So let's go ahead and this is hopefully providing you with not only a big overview, but also drilling down using those subgroups to give you that confidence. And the other thing I wanted to point out, I had intended to do this in the beginning, but when we talk about sectors, oftentimes, whether it's a large mutual fund complex or even a smaller asset management firm, many times they will have what are called sector leaders, and they have individuals, and their entire role is to maintain and stay on top of a given sector and to advise the portfolio managers of the viability of under or overweighting that given sector. And I'm telling you this just to point out to you how important it is. A lot, and some of the other, particularly banks, if you are your job is to maintain oversight of a given sector. When you choose stocks, oftentimes your compensation will be tied to how your stock selection performed versus that given sector. So, again, a very, very key, important component of managing your assets. So here we are. Let's take a look at, again, we're looking at a weekly chart, same time period, and this is, of course, for healthcare. The ETF S&P ticker for healthcare is XLV, so that's what you will want to use. There certainly are other ETFs, but again, I've found these to be very, very useful. So again, the beginning of 2016, that horrific downdraft. What I wanted to point out, the last slide we were looking at technology, and technology suffered during this period. But this, again, healthcare is another sector that came on in that mid-July period. And that was the period when smaller cap stocks were beginning to come alive, growth stocks were being rewarded, and a number of healthcare stocks fell into that basket. So again, just looking, if you were reviewing XLV and staying on top of your sector, you may have noticed that this uptrend really did not last. It faltered, and this is taking you to that mid-August period when Hillary Clinton, at that time the candidate, but very viable, she made a remark, as you may recall, about Mylan Pharmaceuticals and the EpiPen. And with that, she expanded her comments further to indicate her distaste for the very high cost of healthcare, not only healthcare itself, but also medical products. And so the healthcare sector came under tremendous pressure, and many stocks, even though they had very good numbers and growth prospects, they faltered. And so again, staying on top of this type of sector chart would have really put you in front of that, would have alerted you to that, and then of course from there you would of course drill down to some of the other subsectors and see where they are. Now, within healthcare, there aren't as many subsectors. The largest within healthcare is going to be your biotech. There are, I'm going to say, over 800 biotech stocks out there. They're not all, a lot of them are very small, but it is the largest subsector within healthcare. And then the next largest is going to be your healthcare providers, and from there it goes down to the pharmaceuticals, and then your medical equipment, followed by medical supplies. So these are the subsectors that when you are looking at the broader and you start to see that breakdown, you would then want to go and explore the subgroupings to confirm, was that sector indeed falling out of favor. Now this I'm pulling up is again a weekly, and this subsector, it's called the medical equipment, and in this case I'm using Dow Jones, but it is providing you with a view. And the reason I pointed this, I'm bringing this one up, is because this was one of the better performing subsectors within healthcare throughout the year until, of course, more recently. But this particular subsector was able to withstand Hillary's comments and move on. So my point here is periodically you will have subsectors that will withstand their broader sector's downtrend, but eventually they will indeed get caught. And this is indeed what happened with this previously outperforming medical equipment. It did indeed eventually fall. Of course, more recently we're seeing quite a bit of different action given the recent election. But let's go ahead and take a look at this next. This is, of course, the financial sector. And what I wanted to point out to you here is, again, the beginning of the year. And we had a lot of financial stocks that faltered mid-year. And they were coming under pressure for various reasons, depending on what the subgrouping was. There were some hits within this financial sector, but what we noticed from, again, staying on top of the financial grouping was in mid-July, again, it's a reversal rather similar to technology, but it took a couple of weeks for it to come to light, was that financial stocks were starting to indeed come into favor. There were money flows back in. You can see big pickup here in the volume during this reversal week. And what we were seeing here, as well as you'll see in some other sectors, as talk of another Fed increase in the Fed funds rate and then subsequently interest rates, financial stocks tend to perform positively. They outperform in a rising rate environment. So that's what we saw. We started to see financial stocks pick up. Indeed, it was led by a number of banks. Insurance stocks also picked up, as well as some of the asset managers, not all of them. But those are the three primary groups that were very, very positively impacted as we saw the long bond, the 10-year Treasury yield start to rise. These financials started to come back into favor. So indeed, you can see what's going on more recently, subsequent to Trump victory, and that has everything to do with his policies and the banking sector looking upon it favorably. But again, hopefully this type of view, if you are staying on top of these sectors, will get you in front of these financials. Here we're looking at a weekly chart of consumer discretionary, and the ticker for this is XLY. We are looking at a weekly, and as the name implies, consumer discretionary relates to those, for those of you that are really familiar, it does refer to those industry groups that have stocks that will benefit if the U.S. consumer starts spending what's called their discretionary income. After they've paid their mortgage, they've paid their taxes, they have this excess income and money. And so a lot of the underlying, there is one group that is the biggest component, and it's retail, but then within retail you can really drill down in any number of different ways. And as you can see, the consumer discretionary sector has really suffered this year. And again, just looking at some of the subgroups within consumer discretionary, you'd easily be able to see that. This would be a lot of the department store stocks, discount retailers, and retailers in general. Restaurant stocks have been under pressure and underperforming. There are very few areas that within the consumer discretionary that are outperforming the broader markets, and this has been concerning for a lot of economists. Generally, you want to see these consumer discretionary stocks outpacing the markets, because if you look at the gross domestic product, GDP, consumer spending is 70% of that metric, and a strong GDP implies a strong economy. So I will say, I get into a lot of this with my my monthly sector report, where we dig in. Why are the consumer discretionary stocks faltering? Are there bright spots in it? And if so, where? but it's the kind of thing that you can uncover by reviewing and looking at those subgroups within consumer discretionary. And again, consumers, they're a tough lot to please. There's a lot of innovation going on, and quite frankly, consumers can be fickle. If you look at retail, I would say the go-go years in the 90s when teen retailers and a lot of Coach and the purse-related and shoe stocks were doing well, but now consumers are turning their attention elsewhere. So as an example, and I did mention this to you, this is a weekly chart of the restaurant and bar index, and you can see relative to technology and some of the other sectors how really this grouping has suffered and underperformed. And it has a lot to do with, of course, mandated wage increases and food cost and margins and so forth, but the net end of the day is that this part of consumer discretionary as well as others is really dragging on the group. So really key that you stay on top of that so that you don't allocate quite as much to consumer discretionary while it's underperforming, that you do migrate to those sectors that are outperforming and viewed as an overweight. So the next one that we have is consumer staples, and the ticker for this one is XLP. Again, a weekly, taking us from mid-year 2015 to current with 2016. And what I did want to point out to you here is, as many of you may recall, during the beginning of this year and pretty much throughout a lot of this 2016, there was an awful lot of uncertainty swirling around the markets, whether it was related to interest rates, global growth, Europe, of course, with Brexit, and is China growing, is it contracting? So a lot of uncertainty. And so as such, the markets migrated toward areas that offered high yield, and consumer staple stocks indeed fit that bill. But as I pointed out to you, as the talk of interest rates and the bond yields going up, people started migrating away from these high-yielding groups. And indeed, if you had stayed on top and were looking at XLP as an example, you would have seen that breakdown, and it was indeed coinciding with the banking industry going up and as interest rates started to go up. Again, a lot of these consumer staple stocks do provide investors with significant yields. And just to give you an example of some of the subgroups here, food and beverage, both wholesale and retail, drug retailers are in this group, and generally this is the group that will do well in a correction or bear market, because the thinking is that regardless of the broader markets, people always will need food, they will need to go to the drugstore and so forth. Personal products are also a part of this grouping. But here again, more recently, you can see the deterioration as investors were migrating away from these higher yielding stocks, which consumer staples are. So as an example, I just wanted to show you the U.S. Food Products Index. This is not a big one, but it is a subgroup that's making the point. Again, we're looking at the weekly. We did have this peak here in price, and then more recently, the food products industry continues to come under distribution as, again, investors seek yield elsewhere. We are looking here at the next one, and this is the industrial sector. The ticker for this one is XLI, and of course an entirely different dynamic taking place with this group. And just as an example, some of the subgroups here is building materials, industrial machinery, aerospace and defense is in here, transports, transportation services, they're all part of this industrial sector and part of the markets. And, again, staying on top, this is XLI. You may have spotted some of these short burst and reversals that did not go on to last. And so again, drilling down and reviewing the subsectors really will provide you with the further insight. A lot of these, particularly the heavy industrial machinery, are multinational, so the strength in the dollar is going to impact them. But paying attention to these group graphs as well as the subsectors is really going to be beneficial to you. In our last week's report, we highlighted that these groups and stocks underlying should do well after the election, and indeed many of the names that are in these industrial sectors that are on our suggested holdings list are doing really quite well. Here is one of the subgroups for that industrial, and it is the Airline Index. Airlines are rather interesting, and in this case I simply put the daily chart on, and it was to highlight the reversal here. This period is when these companies were reporting their second quarter earnings, and airlines were starting to come in with good numbers. The markets rewarded them. It sat out a good part, but more recently airlines have come in and they are reporting yet another, for the most part, strong quarter in earnings and sales as they continue to tighten their operations. So this is where looking at some of these subgroups can get you in front of these stocks and these groups as they are starting to break out. So let's go ahead and take a look. Of course, energy has been a very, well, certainly prior to now, it's been the prior 2 years have been really, really quite tough. But I will tell you from our work, we were very, very much staying on top of this energy sector, all eyes on it, because we were given an indication here in late January that the index may have bottomed and reversed, but from our work we need to see a little more confirmation. We need to see a break up above key moving averages, even more here, even more conviction here as it breaks up through yet another key moving average. But we did put out in our report in February that the energy sector had reversed, and we were using a long-term monthly chart and the price history on that as an indication. And so sure enough, and this coincides of course with the price of oil. And you know, energy, it's been a very, very mixed market. Not all stocks have participated, and this is where that subgroup work is going to help you, because indeed the pipeline stocks and some of the equipment and service stocks have done a bit better than the bigger integrated oil and gas. Those guys are going to benefit later down the road. But initially there's a need for equipment and services and delivery with the pipelines, and those were the first to outperform. And then some of the other subgroups here are going to include coal and then renewable energy, solar, wind, and so forth. And that grouping has not been doing well at all, but certainly some of the select other groups that we mentioned earlier have been. But more importantly, using this XLE and visually being able to see that indeed a reversal may have occurred, drill down into those subsectors to confirm it, and then from our work we would suggest overweighting it because money flows, underlying groups look healthy, and you want to participate. So the utility sector, and of course we're drilling down into some of the much smaller groupings, but the utility sector, as many of you may know, is another area that offers stocks beneath that sector that have very, very high yields. And it's another area that is viewed as defensive. So if the markets were entering a corrective mode or a bear market, utility stocks do well, and all of that has to do again with those high yields. So what you may notice is a correlation, and quite frankly into mid-year utility was far outperforming the broader markets, with energy coming in second performance-wise. But indeed, as mentioned before, during this period we started to see yields rise, there was talk of an interest rate increase, and so we did see a rather slow but clear-cut rotation out of these utility stocks. They were no longer in favor. Now, I will say it was not only interest rate driven. Quite frankly, when you look at the move that it had, a lot of these stocks were very, very expensive. Their multiples had expanded to levels that were historically quite high. So you had two factors going. But most importantly, again, you're looking at this graph. You're seeing that there is a reversal. It's breaking down through key moving averages on significant volume. More volume on down weeks than up. It's telling you that it's time to move your monies into a more favorable sector. And some of the subsectors here for utility, of course, are water utilities, gas distribution, fixed line telecommunications is another one, and then your conventional electric utility stocks. And that's just giving you an overview of some of the subgroups that you can take a look at to really confirm indeed that there has been a reversal away from utilities. And let's go ahead, and this is the material. XLB is the ticker, and this is certainly a more unique group as far as looking at some of the underpinnings, and really most importantly looking at how this group performed this year. I would say that one of the heavier weightings is gold and gold mining stocks in particular. So what I'm pointing out here is the beginning of this year. Now, you may have noticed most of the other sectors were still in a declining phase well into February. But what we saw here in January was a reversal into gold. And you can understand why. Oftentimes gold is viewed as a safe haven. And in the beginning of the year, we had that terrible downdraft after China's markets were halted 3 days in a row. The U.S. markets went into a little bit of a panic mode, for lack of a better word. So there was a migration into gold. And so at first you would think that that was perhaps a short-term move, that it was panic-driven and that it would end. But again, by using XLB or another material sector and then subgroup, the next chart we will look at the gold miners, you can see that the move up was indeed had legs, and gold stocks went on to great heights well into this June period. So again, paying attention. Now, some of the other subgroupings here are going to be steel, aluminum, paper. There's also special chemicals, and then some of the other commodity, platinum and precious metals are all part of this materials sector, but you can see how there was a very long-lasting move into this. And I mentioned I would show this to you because we did put a couple of gold mining stocks on our list in the beginning of the year. We were able to capture some of these moves. This is the Gold Mining Index, and indeed you're looking at a group that tripled during this time period as these gold mining. So really paying attention to not only the broader sector, but those subgroupings is truly going to benefit you as you make decisions on where to focus your efforts, where to put your money to work. This sector, being able to stay on top of that is really, hopefully I was able to show you how beneficial it can be in helping you make your decisions. So let's go ahead and review some of the conclusions after reviewing all of these, and I've said this numerous times and hopefully you were able to view that using sector allocation as part of your investing process, it really will pay off. And so in this instance, I provided you with 9 tickers so you can see that it's not terribly taxing for you to stay on top of that, but also you will want to stay on top of the subgroupings beneath that. And then you want to make sure that, of course, the stock that you are looking into and that you are purchasing, you want to make sure that it's in a favorable sector. And then also, hopefully, I was able to point out you want to get out of that stock if it is in a sector that is coming under distribution, rolling over, and you will see these money flows into and out of given sectors. I will say, having done this for many, many years, this year has had a lot more in the way of rotation. There have been head fakes into various groupings, but if you are really knowledgeable and you can understand why a sector would be in favor and why it wouldn't be, hopefully it would help keep you from being whipped around. But again, for those of you that may have struggled, it's been a very, very tough year. I talk with a lot of my institutional clients, and a lot of them are scratching their heads. But it is something that, even though there was a fair bit more rotation this year, you could still very easily have capitalized on some of these moves. So let's go ahead and I mentioned this quite a bit, know yourself. So if you're devoted, go ahead and do the screening. A lot of people don't have the time to really dig down, look at those sectors, look at the subgroup groupings and see what's working. The newsletter, I do a lot with sector work with my weekly report, but my monthly sector report is really, really impactful. It ranges from about 12 to 16 pages. It provides you with overweight, underweight information, and I'm pointing that out because today I do have a very, very special offer for you to look at. And this report just went out 2 days ago, so it's still very, very timely. It's filled with information relating to the election and the impact that will have on various groupings. And also in this report, there is a lot of talk about where we are in the broader markets. What phase of the markets are we in? Given that phase, what sectors are poised to outperform? A lot of, there's also a ranking that is given to each sector, and it's based upon history going back 20 years, whether that given sector for that upcoming month has on average closed higher or lower, the underlying stocks, and then a score is provided with that. But I think most importantly with this report is the subgrouping work. I mentioned that not all groups within a sector are going to be working, so I did want to provide you with this one-time offer. This is the first time ever, and I think I've mentioned to you what you will get as far as in this detailed report, and you can get instant access on here, and you will want to put a now unfortunately the promo code for some reason is not showing up here, but it is the $19 and the word offer. So we'll go ahead and add that somewhere. But for those of you that want to get on top of where the markets are headed and what looks attractive currently based on the environment, I would urge you to take a look at this report. It's just filled with a lot of information, a lot of statistics, and very meaningful insights into these subgroups, and then also into individual stocks. And I apologize, I did not mention that in the beginning we'd be doing questions at the end, but I would be very happy to answer any questions at this time. And I'm going to answer some of these questions that talk about, someone was questioning subgroups equals industries, and yes, that does, when I talk about subgroups, I'm talking about industries. For those of you that subscribe to investors.com, they have 196. Some of the other services that I use do not have as many, but those industry groups are really going to help you. And someone wanted me to discuss the most stagnant sector, and I think we did review that. I would suggest that the consumer staple has been the most stagnant, although there are some bright spots within that that you can. And then if playing sector rotation, this was a question relating to baskets, whether you should do ETFs or individual, and that is, JQ, a great question, because you can do simply the ETFs. Your returns aren't going to be as phenomenal as some of the underlying stocks, but you can very, very easily participate. And I know a number of people that have done that with, for instance, the move into energy. There was not clarity in the beginning as to which groups would benefit from an improvement in oil prices, so simply purchasing XLE would have enabled you to participate and take a lot of the guesswork out of it. And then actually, yes, so I have to see how I can, the promo code, I apologize, I am not that familiar with how to do that, but it is $. Let me just see if I can, I hate to take away from questions, but this was one of the questions, so I'm going to see if I can do that. Yeah, I'm having difficulty and I apologize, but what you would do is in that promo box, the $, the number 19, and then PROMO, capital letters. Actually, I do have it listed right up here. So this is the promo code right here for those of you that are interested. Now, the next question talks about XLE and the early indication that it bottomed in January. Now, I did not pick up on that. It was too early from our work. We were not on top of that until February, and I apologize for not putting a longer term chart on there, but if you were to look at a longer term of XLE, we were looking back 4 years on the price of oil, and it was just starting to break out above that, and that was the conviction that we needed. And also, it wasn't until mid-February that XLE broke up above the 50 that would give us at least partial conviction that the bottom had occurred. It was not the hammer candle in January from our work. That was still too early. We like more conviction behind us before we embrace a particular group. And yes, ETFs, someone asked, do we cover ETFs for countries? And indeed, particularly our weekly report. Earlier this year, we noticed Brazil, EWZ, was picking up, and it had to do with stabilization of the political scene as well as the economy. They started, even though they're awfully high, but Brazil has started to reduce their interest rates, and so EWZ has been a good play. We put on ADRs, a Chilean airline, because of this move in South America. So yes, we do pay attention to international, and as you should. It should be a part of your work. And so this is, this will, if you were to participate in today's offer, you will receive the most recent report. Again, it's only been published for 2 days. It's still very, very timely as the information in it, as far as where we are in the markets and what you can look forward to over the next couple of months until, of course, our December report. There's an awful lot going on, obviously, in the broader markets, but our commentary was still has impact regardless of this current extremely choppy period. And Jan, there was a question about okay, yeah, what comes in there? So what this particular offer, you will be provided with this month's report that is, again, normally 19, and you can take advantage for only 19, and it's just filled with lots of, this is the type of work that I do for my institutions as well, and I've gotten wonderful feedback. And then, let's see, there was a question as net T's in XLK, and Mike, yes it is, because XLK is the technology sector, and net T's is a software stock which is in technology. And then someone else asked about the moving averages, and they were simple, not exponential. I tend to find that they work better, particularly in using weekly charts. Someone else had asked about a seasonal chart for the sectors, and that's stockcharts.com does that, and I do some work with that on my sector report as well, because indeed there is a definite seasonality with these sectors. And again, I want to thank those of you that joined us. For anyone, how many pages the report is varies. It's going to be anywhere from 12 to 16 pages on average, depending on where we are in the markets and what needs to be relayed. But it is it's detailed and lengthy, gets a lot of meaty subject matter in there. And the link is that HTTPS CQ253. That whole in blue area is a link that will get you to that report. And Steve is asking, does promo apply going forward? This is just for that November report. If you are not interested in getting the report in an ongoing manner, it's very, very easy to discontinue, but the normal monthly price is $49. So if it is something that you feel adds to your investing profile and what you, as I believe that you will, you can very easily just stay with it going forward. And I believe that is it for the questions. And for anyone that has any further questions, my website is on here. There is an access. You can reach out to me individually with any questions or comments. I'm always open to sharing my knowledge, answering any kind of questions that you might have. And I thank you for sharing and taking the time to get into sectors and really how important it is and can be to your investment process. Thank you.